So despite concerns over Fed independence, stock markets hitting record highs in Canada and the US. Let's get more from Art Hogan, Chief Market Strategist, B. Riley Wealth. Art, great to see you. Thanks very much indeed. I mean, this is the latest installment in this Trump-Powell friction, but it looks like the administration's stepping things up a bit here.
It certainly feels like that, although the administration is not taking credit for the DOJ actually lobbing those subpoenas over the weekend. But, it's pretty clear the motivation here. And it's a pressure campaign to get either Chair Powell to leave the Fed or leave the Fed after his chairmanship's over in May, and he could stay through 28 and be a governor. So clearly, another level of craziness in what has been an ongoing dispute between the president and the chair of the Federal Reserve. And clearly the market reaction has much more to do with how much logic is being infused by everyone that's reacting to this today, whether you're Republican or Democrat. Everyone's denouncing this action and reminding us the importance of a independent central bank, and that has a lot of historic precedence to it. The clip you ran with my friend Elizabeth Schultze earlier just talks about how this goes bad, and unfortunately in our lifetimes we've seen this with Arthur Burns and the Nixon administration, and the ramifications for that were devastating for the economy. You also can just look abroad at countries like Turkey that had lost independence of their central bank and skyrocketing inflation. So there's a lot of historic precedents to all of this, and none of it's good. But luckily, everyone's coming out denouncing this, whether they're a former Fed governor or a Fed chair or the Secretary of Treasury, across the aisle, both Republicans and Democrats.
Yeah, Hank Paulson, who served under President Bush, among the former Treasury secretaries, criticizing this. Talk about the markets, record high, so equity investors don't seem too worried. You say that projections for U.S. economic growth may be too pessimistic.
Yeah, so the average estimate for the GDP growth in 2026 by a consensus of economists still sits at 2.5%. And clearly with the kind of productivity gains we saw in the last 12 months, and certainly with the amount of CapEx we're seeing, we think that's going to be north of 3%. Right now, the Atlanta Fed has a GDP tracker that has the fourth quarter coming in at closer to 5%, and that a lot of that has to do with imports and exports. So there's a bit of an aberration there, but the average is 2%. We think we're going to be closer to or north of 3% this year. I think that drives earnings growth. Estimates right now for the full year of 2026 sit at about 12% earnings growth on about 8% revenue growth. Both of those may be conservative as we get to the middle of this year.
We get reports from your big U.S. banks this week. You say the bar to impress investors is going to be high because a lot of them are at or near record highs.
Yeah, that's where things get tricky. So you come into reporting season, if either as a company you're trading at all-time highs or as a sector like the financials, which had a very good 2025 and have had a strong year-to-date performance, come in and report, that sets the bar up there. So even if you beat and raise, sometimes that's not enough, and you get that counterintuitive reaction function where things sort of settle in, take profits, and usually generates an opportunity to get back into a sector. We certainly have seen that over the course of the last 12 months in a lot of the artificial intelligence darlings, the mega cap technology stocks, where they report. NVIDIA is a great example of that. They had a spectacular report, and the stock hasn't done anything since then. So, but I think the important thing is, as we enter earnings reporting season, we're actually seeing earnings growth from sectors not related to artificial intelligence. So things like financials and things like healthcare are coming in and throwing off great earnings estimates. We suspect that guidance for this year is going to go up, not down, after we finish up the earnings reporting season.
This threat by the president to cap rates on credit cards for a year, hard to know if that'll come to pass. The banks, one assumes, will fight it furiously.
Yeah, and it serves the wrong purpose, right? So if you're trying to help people that need credit, putting a cap on what banks can charge will take them out of the credit card environment. So banks aren't going to lend at a set rate for people that actually need the credit card. So that's only going to help people that don't need credit cards, and it's not well thought out, and I don't think it's something that ever gets passed. But it actually is a deleterious impact on the people that need credit cards the most.
I just want to break something here. Central bankers, of course, known for their caution, but our own Bank of Canada Governor Tiff Macklem has issued a statement saying he offers full support for Chair Powell and he calls central bank independence critical. It's interesting that the Bank of Canada would speak out on a US issue like that.
Yeah, I think it actually speaks to the point that central bank independence is sacrosanct, and that is something that needs to be protected, whether you're in Canada, the United States, or any central bank around the world. It's well-known economic theory and fact, and that's why you're seeing so much pushback by this. I think it's the right move for the central banker in Canada to do that, and I think we'll probably hear more from central banks across the globe.
I'm just looking. So we get back to the bank earnings. So it looks like we get JP Morgan tomorrow and then Bank of America, Citi and Wells Fargo on Wednesday. Is there anything in particular investors should bear in mind differentiating those stocks?
Yeah, well, those are all the large money center banks.
Yeah.
All of them have different portfolios of business. JP Morgan just happens to be the largest of those. I would look towards guidance over capital markets activity because that's picked up. We have a threefold increase in mergers and acquisitions that have been announced this year. Mm-hmm. We also see massive volatility in trading. So I think all the banks are going to fare well. And remember, we're still in a light regulatory touch environment, so they can do a whole lot more M&A activity internally with banks.
Yeah, it's interesting. Just back on the credit cards, maybe we could put up Delta, DAL, or United Airlines. I think it's UAL, because the airlines make billions of dollars selling miles to banks and credit card issuers. That's a huge part of their business now, a very high margin part. So if there was any curtailment of credit card issuing, presumably it would be bad for them.
Yeah, certainly. And that drives a lot of decision making for the credit card users, right? So, we use the American Express so that we can get into the Delta Lounge and we do it. And, travelers take advantage of those things. And it's a big selling point. So to the extent that Visa and MasterCard are the folks that clear all of this activity, it's and the banks are the issuers of credit cards. You have to remember where they're coming from and what's in your wallet really stands out as to what benefits are you deriving from this. And I think that it's not just the airlines, it's the hotels as well. Yeah. So I just think it's a very, very bad way to do something that you think is going to be positive for people who need help.
Art, thank you very much indeed. Art Hogan joining us there, Chief Market Strategist at B. Riley Wealth.